Welcome back. Turning our attention now to Sterlite Technology. It's been a weak Q3 for the company. In fact, the last couple of quarters have been subdued. For the last 6 quarters, the company has been reporting a negative revenue growth on a year-on-year basis. In Q3, revenues were down 10% quarter-on-quarter and down 4.5% on a year-on-year basis. Ankit Agarwal, Managing Director at Sterlite Technologies, is with us on the show. Ankit, thank you very much for joining in. First, just zooming out for the benefit of our viewers, it's been tough for the last 1.5 years. What are the top 3 pain points for you?
Hi, Rima. Thank you for having me on the show. So I think as we've been guiding the market, I think principally we've been focused on creating our innovations and taking our products, especially into Europe and North America. Particularly in North America, we've seen a huge amount of inventory, excess inventory with our customers on the telecom operators and fiber operators. That has definitely been reducing quarter on quarter, and we've seen that now meaningfully come down over the last 6 quarters. And I definitely believe that where we stand now in the next 1 or 2 quarters, we will see a strong return in demand in terms of the optic fiber cable and the connectivity requirements. So I think this has been the primary driver for the demand. As a result of this, our factory utilizations have been in that 50% range. And we've definitely seen that we have a very strong operating leverage. So this 10-12% EBITDA margins that we're running currently will move towards 20% very, very quickly as we move towards around 70% utilization. So I think we're just at that tipping point where as we see this demand coming back and we see growth in our cable and connectivity on the back of 5G, data center and everything else, we're quite confident that we'll move back towards the 20% EBITDA margins.
By when, Ankit? And do you think in FY26 margins get back to 20% and on the top line there is growth? When does the recovery kickstart?
Absolutely. So I think we're just 1 or 2 quarters away from that. We're already seeing increased interest from our customers. Our pipeline is strong, both on the cable business as well as on the services business. So I think from a pipeline perspective, we are confident. We've been focusing on 2 or 3 things. One is working very, very closely with our customers and innovating. We've actually increased our patent count to north of 700 patents now. On the second part, we've been focused on our cost structure. And if you look at our fixed costs, people costs, admin costs, all of that has come down steadily. And that is also further contributing to our profitability. So I think with all of this coming in, we do believe our revenues will be higher in the coming year, and also our profitability will improve. Most importantly, we're also working on cash generation. And post-QIP, we had a meaningful reduction in our debt. But now we're also looking at how do we generate more cash from the business and then reduce our debt further in the coming year.
Ankit, you've been quite selective in the services business, which has actually impacted your top line, but margins have been stable or improving, especially in that particular segment. How much would you like to scale up this particular business to, and what are your margin aspirations here?
Yeah, absolutely. You're spot on. I think we've been guiding that we're going to be very, very selective in the kinds of projects we take up. Broadly, we've been saying that, look, we want to look at opportunities in the PSU, in the private space, but more and more on the system integration and value-added services. That's really where we're focusing. You will see us winning more and more of data centers / system integration projects going forward. I must say that our pipeline is stronger than it's ever been in this services business. So we're very excited with the kind of opportunities coming up. And as we've been guiding, we broadly want to move from about 6-7% margin towards 10 to 12% margin, which I'm confident that we'll move coming into the new year.
Okay, so for services, the pipeline is better than it ever was, and margin should get up to 10 to 12% by FY26, the middle of FY26?
No, I won't be able to give a specific timeline, but I think directionally, when you look at the projects that we have, for example, we won a 2,600 crore project in Jammu Kashmir. We do expect the APO for that to come into us in the next few weeks. We look at new system integration projects that we should be winning and announcing soon. I think directionally, we should start moving in that 10 to 12% range.
Okay. And what about digital? It's the first ever positive EBITDA quarter for you. What led to that, and is it sustainable?
Yes, absolutely. So I think that's been the target and the focus for the team. We've been very clear that, yes, we want top line growth, but it has to be profitable growth. So far, we've got to our first EBITDA profitability, and eventually the whole thought process is we should have cash profit in the business. So I think, again, we are broadly running at about 70-75 crores revenue per quarter. As that moves towards, say, 90 to 100 crores, we're confident that we should have cash profit as well. So that's really the focus. We have some marquee customers in the US and globally. And we're very confident that as we keep scaling that up, we should move to cash profitability in that business.
Ankit, give us a sense of how you expect order book trends to pan out. On a year-on-year basis, it's down, but sequentially it's up. So Q4, what is the executable order book? FY26, where does it stand at? And how is the pipeline looking, if you could give us a sense of both domestic as well as international?
Yes, absolutely. So just to give you a background, this is kind of 3 or 4 trends that are happening in parallel. We've clearly got massive rollouts still going on for 5G globally, where you've got to connect all your tower sites, 70-80% of them to fiber. The second major trend you have is fiber to the home, both urban and rural. On the rural side, you've got massive government projects going on in the US, in India, etc., like BharatNet. And then the third major trend that we're seeing is because of this advent of AI, you're seeing far more fibers required within the data centers and to connect the data centers to the scale of 5 to 10 times. So as we get more and more of these AI built DCs, we're going to see more and more of fiber requirements. One very important trend we're seeing in our own business is that our data center plus enterprise segment, which is a customer segment for us, contributed to more than 20% of our revenue. So that's a very interesting and fast growing segment for us that will pan out over the next 3 to 5 years as well. So when I look at all of these 3 trends combined, I really believe that we're at that tipping point where things should start improving. As I said earlier, our pipeline is already growing both for our cable and our connectivity. Our attach rate is north of 20%. So really from us now is about really making sure the pipeline pans out. We execute on this and our factories get utilized from north of 70%. At that level, we've proven in the past that we can clearly get 20% EBITDA margins.
Ankit, one last question. The global services business, it was supposed to be demerged, listed. What is the timeline for that? Are you on track?
Yes, absolutely. So I think broadly we're looking at end of Q4 or early Q1. And again, I think that's a tremendous opportunity to create value. As I said, we really see the services business looking to scale up and scale up profitably from here. So post the demerger, I think there can be very good value creation for shareholders.
Thank you so much, Ankit, for joining us, giving us a sense of how Q3 panned out, how Q4 is looking, and we wish you all the best for FY26 as well. Let's now take a short break. Up next, we'll discuss market fundamentals with Anirudh Garg from Invaset PMS.